So this is a planning question. Do you have any examples of like poor financial decisions made by clients that kind of have, changed how their or changed their plan in a sense or their success rate?
Yeah, this question came in, so I've been thinking about it. It's kind of interesting. We have 270 households that we are helping, and it's amazing actually how infrequently they do something wrong. Partly because they ask us for our opinion, but even when they don't, they still tend to do pretty well. And that's why they're our clients. That's why they have money. Because really, the people that aren't our clients, the number one financial piece that people mess up on throughout their lifetime is the inability to save. Almost all my clients have a very similar story is that, my dad or whatever told me to make sure I save 10% or more, and then just pretend like it's not there. And so those people that can't do that, right, they aren't our clients. Because the average person here in the U.S. does not have a lot of money, and so sometimes there's no way to save because you don't have enough revenue, and enough income and those types of things. But that's a big one. But that's not within our clients. When I look within our clientele and look at some of the things that have happened, I would say one of the things is just a lot of people have almost all of their assets in their house and an IRA. Maybe that used to be a 401k at work. And nothing particularly wrong with that. That works quite well, but it does kind of create a little bit of a restriction. And so then they want to do something big with the money, and it's really hard to get big money out of an IRA because it pushes you up in the tax brackets, and you can end up spending an awful lot of money on tax as far as that goes. So I would say continuing to develop money outside, not just emergency account money, that's important, but money in stocks and bonds or what have you, that's in a taxable account that's outside of IRA is important. Um, so sometimes, that's something I've seen that could be improved. Then the sequence of withdrawals. So somebody gets into retirement. Where do you withdraw the money from? When do you take Social Security? Okay, that's a big issue. But even ignoring Social Security for a minute, where do you take the money from to live off of? And so I see a lot of people who just automatically go to start taking money out of their IRA accounts. And the comment I hear all the time is, hey, these are my retirement accounts, and now I'm retired, so I'm going to start taking money out of those accounts. But if you run the numbers, that's not as good as taking money out of your taxable accounts first because the capital gains are lower taxed. Some of that you've already paid taxes on, so you can get some of that money back without any tax, and allows the IRAs to continue to grow tax deferred, which can be quite powerful. You definitely don't want to be taking money out of your Roth type of accounts until the very end because those are growing tax free. So the sequence of withdrawal is another area where there seems to be a lot of confusion, as far as when to take what. So that's something I think that, is another area to focus on as far as that goes too. But for the most part, it's kind of amazing how well yeah, people have, made their decisions and kind of moved through their financial life. And again, that's why they're our clients.
Yeah, another one that we've talked about a couple times is letting your winners run. And
Mhm.
sometimes we've seen where you sold winners too early, or these are kind of pieces or assets of someone's portfolio, and it's maybe doubled, but they kind of said, "Okay, I'm selling now," instead of letting it run for a little bit longer.
Yeah, now that's a good point because you could be onto something. I mean, if it's already doubled in a fairly short period of time, whatever it is, or even gone up 20%, whatever it is, you could be onto something that could be huge. And we've got a client that bought $14,000 worth of Apple in '96, when it was not looking good for the Apple, honestly, at that time. And it's worth millions now, but that client never sold any. They could have. Maybe when it turned into 28,000, I doubled my money. To take it as be pretty happy. That's a good rate of return. But man, letting it go and turning it into millions is a much better option. So yeah, I'm a big proponent of trying to keep some of these things just keep going. You know, with Adobe or whatever it is, they're really well run and they keep on moving. One strategy that we employ is what I call the fruit tree strategy. So in other words, we'll pick some dollar amount. So when that thing gets to $1 million or something, we'll start to take money off and just to diversify. So it gets to 1,200,000, I'll take $200,000 off, and so next year it turns into 1,100,000, I'll take $100,000 off. So it's like I call it the fruit tree because it just keeps kind of producing, and that way we can diversify. And so it's a sort of splitting the difference instead of selling the whole thing just because it's up a lot. I have had clients that kind of panic. It's like, oh my gosh, this is up so much, and then they sell a big chunk of it, and it keeps on going. So anyway, that strategy, letting the winners run, that's a difficult one to employ, but there are some ways to look at it and some ways to maybe do it that do help, at least mentally. So yeah, it's a good point. It's a good point.